Yes, sir.
Good evening, ladies and gentlemen. I, Chaniksha, Senior Executive Secretarial of RACL Geartech Limited, welcome you all to the post-result conference call of the company for the fourth quarter of 2023-24. I shall be the moderator for this call. Before we start the proceeding, all the participants may please be informed that this conference call might contain forward-looking statements about the company which are based on beliefs, opinion, and expectations of the company as on date of this call. However, these statements are not guarantees of future performance and involve risk and uncertainty that are difficult to predict. Further, you may please note that all participant lines will remain in silent only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need any assistance during the conference call, you may post your concern or query, if any, in the question answer box available on the right hand, or you may raise your hand as available in the right hand corner of the screen if you want to speak during the call proceedings. Lastly, please note that this call is being recorded. We have today with us the management of RACL Geartech Limited, represented by Mr. Gursharan Singh, Chairman and Managing Director of the company, along with Mr. Jitendra Jain, Chief Financial Officer of the company, and Mr. Prab Meher Singh, Vice President, Finance and Business Excellence of the company. I now invite Mr. Gursharan Singh for his opening remarks. Over to you, sir.
Hello, colleagues. Hello, friends. First of all, good afternoon to all. In first session, is second call or first call during this financial year?
This financial year, first call.
First call. So last year we had achieved a growth, and it was almost 16-17%. We closed the years with good numbers. Against all the headwinds, we are still continuing to grow together, and we always relish and appreciate the confidence, trust, and support being given by all our investor friends, all our shareholders, all our stakeholders, and I do welcome all the colleagues on this forum, my friends who are sitting over here, my colleagues who are sitting over here, and all colleagues who are in our factories. Join me in welcoming you all. So, as our routine quarterly performance, we always share the key numbers, key highlights, and of course, then have it as a Q&A session. So I definitely now give the forum to Jitendra Jain and Prab to take it forward. So I'm always there to answer your queries along with my colleagues. Thank you,
Jitendra. Good afternoon, friends. Good afternoon, everyone. This is Jitendra Jain, the CFO of the company. I give a warm welcome to everyone. Luckily, after many days of heat wave, today we have a light rains, and the climate has become better in Delhi. So I think that's the good thing. So yeah. So we'll start with the presentation first. The next slide. Next one. Yeah, so this slide, I think most of you are already aware of this slide, but I'll just brief on this slide for anyone who has joined us our investor call for the first time. We have established in 1983 for FY23-24. We clocked an overall turnover of 423 crores, close to $51 million. Our product we have around 22 active customers and 900 plus SKUs in our portfolio. The products which we manufacture generally have applications in two-wheelers, three-wheelers, passenger cars, commercial trucks, ATVs, agricultural equipments, and industrial gears. We are headquartered in Noida. The company has two manufacturing locations, one at Gajraula and one at Noida. Our corporate office is based at Noida, and we have three warehouses in Europe. Our product range are transmission gears and shafts, sub-assemblies, precision machine parts, chassis parts, and industrial gears. Our core strength and core competencies are in gear cutting, precision machining, aluminum machining, process R&D and concurrent engineering, heat treatment, sub-assembly, laser welding and laser cutting, and export logistics handling. We are rated A minus. Credit rating is A minus by CARE. We are listed on Bombay Stock Exchange, and we have 100% subsidiary of RACL Q4FY24 Limited, which is based at Austria. The company has all the certifications which are required, which is ISO, IATF, and T6 certifications. Next. Coming to the financial performance for the last quarter of financial year 23-24 and the full year. So this slide gives quarter on quarter comparison of the numbers. The company has achieved a turnover of close to 115 crores in Q4 of FY23-24 as compared to 96.31 crores of same quarter last year, which is a growth of close to 19.32%. Our EBITDA margins have grown to 24.45 crores as compared 24.45% as compared to 23.61% of the same quarter last year, which is a growth of close to 3.5%. However, our PBT on quarter basis have declined by almost 16.87%, which is
No, 1.6.
16.8.
No, no.
Percentage terms. Percentage terms is 16.8%. But this is predominantly because of higher depreciation and a slight higher financial cost.
Yeah.
Basically, this is quarter on quarter. Next one. This is the full year performance. Basically, I'm happy to share that the company has clocked a turnover of 423 crores in FY23-24 as compared to 367 crores in FY22-23, which is a growth of close to 15%. Our EBITDAs have grown from 101 crores close to 102 crores as compared to 90.68 crores, which is a growth of 12.4%. Whereas grown from 51.33 crores to 53.74 crores, which is a growth of 4.69%. Now, this slide gives a snapshot of all the key issues which are there. I mean, we'll leave this slide for a few seconds for people to get it, look at it. Next. So this is a slide which I wanted to everyone to focus on. This is a brief snapshot of slides are not just friends. This is a rich in movement of these. किसी को नहीं दिखाया हैव यू रिसीव मैसेज या आप ऐसा में आपके इस पे नहीं आता काम कर उसमें मत खोल नॉर्मल बोर्ड
उसमें पीपीटी मोड में कई बार नहीं चलता।
में हाँ ये पीपीटी चल रहा है सारा शेयर
Roughly 11 crore is actually
replacement. इसको ऐसे ही रहना I'm extremely sorry. I think there was some technical glitch while we are displaying the presentation in a PPT mode. So we'll display in this mode. I hope everyone is able to look at it. So this is the slide which gives a snapshot of brief of our financial ratios. So we'll leave it for a few seconds for everyone to just capture it. Next. So this is the slide which basically gives a snapshot of company's performance in last 3 years. So in the from FY 2021 to FY 2024, we have grown our turnover by in absolute terms by almost 2 times, and our EBITDA margins have grown by almost 1.8 times, and our PBT margins have grown by 1.78 times in last 3 financial years. Thanks. So coming to the latest developments and business updates. So this is regarding the Project Titan. Basically, the Project Titan was, if you remember, last time we had shared that the company has received a nomination as a tier one supplier, series supplier for a premium German car manufacturer for supply of parking lock mechanism for passenger cars. So this was one of the biggest milestone in the history of RACL, where RACL has been nominated by a car manufacturer as a tier one supplier. So just wanted to give an update on the Project Titan. So basically, if you see, this is a overview of our plant at Gajraula. So we have already allocated a separate shed for the Project Titan. Uh, First set of plant and machinery which are required for these projects are already being ordered. The joint inspection of the production of samples along with the customer has already been completed. The customer was here last week, and the joint inspection of the production of samples is already completed. The functional build samples for assembly trials at the customer lines, it is expected by July end. Then the next build phase on series production line is planned in February 2025. And then if everything goes off well, then we are expecting the start of the mass production last by August 2026. Second update is on the Noida plant, which we had shared last time, that the company has shifted its Noida plant to a bigger location in sector 80. where the plant is almost 23,000 square feet in feet. So the 30. 32,000 square feet. So just I'm happy to share with everyone that the plant is fully operational now, along with the official staff. The all machineries which are required there have already been installed. We have shifted majority of the plant and machines from our older plant, and few of the new machines have already been installed, and the plant is fully functional now. I'm happy to share that it was a great effort by our entire team, including of course the team of Noida plant, and we had been able to shift the entire plant without a loss of even a single day of production, sir.
Yeah.
Without a loss of a single day of production. So that shows the team efforts and team strength of RACL. Next is if you friends, if you remember last time we had shared that we had lost some of our business in FY23-24 because there was a mismatch in the gear grinding capacity last year. The gear grinding capacity, which was supposed to be fully functional, installed and functional by around July-August, if the machines got delayed and all, and finally the machines had come in, and the full-fledged gear grinding capacity became functional by January, December and in January. So I'm happy to share that that mismatch in gear grinding capacity, which had impacted our business in FY23-24, it has been rectified. In fact, learning from this experience and all, we have now ensured that because gear grinding is one of the most important part of our manufacturing process. So we have now installed a sufficient gear grinding capacity, keeping the projected growth in mind, including a bit any such exigency in future as well. So thank you. This was an update and on the financials and the performance of the company from my side. We can open the meeting for questions now.
Yes.
Start with we have received questions from some people.
Yes, maybe you can unmute.
Divyansh.
Yeah.
Yeah. Hi, everyone. You can hear me?
Yes, this is Divyansh, correct?
Yeah, Divyansh.
Yeah, hi Divyansh. Yes, please proceed.
Okay. Sure. I have, let's say, 4 questions which are on the same topic. So I'll go one by one. So just first wanted to understand that from last year annual reports or previous ones, I see that the company has been using bill discounting as a mechanism for cash generation. So first question is that in an accounting treatment and in cash flow statement, where does the cash generated or mobilized from bill discounting captured? Is it cash flow from operations or is it in financing activity?
Yeah, so Divyansh, we follow the Indian accounting standard here, and on a conservative basis, whatever the bills we are discounting only export bills as of now, and so our receivables remains outstanding as a part of our operating activities. We do not knock off the receivables, and the bill discounting cash portion basically is there in our books as bank outstanding, and as against this, the cash from the financing activities get impacted. We do not knock off the debtors because ideally, I mean, some companies I understand may follow once they discount the bills, they knock off the receivables, but we do not knock off the receivables. So receivables are there, and once we receive the actual payments, then the bill discounting that gets knocked off.
Got it. So therefore, the account receivables that is there
in
the financial statement includes the bill discounted amount as well.
Yes.
Yeah, actually, as a corporate governance, just to add what Vijay said, as a corporate governance, we do not knock off the bills until we get
knock off the receivables. Knock off the receivables.
So we don't actually knock.
We do not knock off.
So we always show as account receivable. So that is a corporate governance we maintain.
Understood. And
Divyansh, I would request in this paucity of time, if you can brief your questions into, we'll come back again, but if you can have 2 questions per person, please.
got it. So the second question is, see, if I see our cash flow statement, right?
Yeah.
30 crores of cash flow from operations, and our interest is around 26 crores, right?
23 crores, 23
24 or
crores, 23 crores.
right? And because of the elongated working capital, which is expected to go up even because of, let's say, export orders increasing more, seems that we will always be cash constrained, and we'll always keep on um, taking more debt to keep continuing our operations. So the question is that what are the levers that the company has to, let's say, optimize on the working capital? Because it's becoming a drag in our overall part. We get the top line, but does not show up in the bottom line.
No, so Divyansh, to answer your question, we need to understand our business model. Now, please, if you look at the other auto component suppliers and all, now our almost 73% of our turnover is exports. And okay, and which is the reason our EBITDA margins are close to 25%. Now exports when they are there, there. And one more thing, if you would have noticed, our raw material component is just hardly 30%. The rest is all value add. So of course, our overall manufacturing process is longer. And then the exports generally have a higher working capital cycle, but that gives us a higher margin as well. Now, whatever, because this higher working capital cycle portion, which is there, which is part of the working capital, which is part of the overall export mechanism, we basically generally built in.
I'll add what once you finish.
Yes, sir.
No.
Achha, okay.
I'll also.
You'll also add. So Divyansh, we basically the costing which we do is on a per part basis and all, and this working capital elongated cycle, first of all, that is part of my costing there. Now, second thing to answer your question, yes, we understand that higher as our exports volumes will increase. At this time in FY 23-24, there was a bit of a disturbance because of the Red Sea issue, which most of the people had faced and all. And when the Red Sea crisis had started and all, the overall shipment days have almost increased by 25 to 30 days. It has come down to almost 10 to 12 days now. And
I will also add what JJ said. Look, Devansh, to tell you very clearly, when export is growing, when our business is growing, top line is growing, obviously working capital will grow. So there is nothing to shy away from.
I understand why it is growing.
That will grow because, let me complete. Our working, because if we are growing every year 20, 25%, 30%, obviously a major growth is coming from exports market. Obviously, export receivables, nothing is going to change for me because if shipping time is 70 days, shipping time is 70 days. We can't really do much. Eventually, customer has to pay its own receivable time. So eventually, when we grow our business, when we grow our business cycle, obviously working capital will also grow. So there is no cause of worry for that. The only thing is your business should sustain this. A business is sustainable because our costing takes care of that. Because, if you're having higher volume of working capital, so eventually we have to pay additional working capital cost or additional finance cost. But if our business or our costing takes care of it, then there is no cause of worry. Because when we do the product costing for export market, we always cushion that additional cost burden erupting out of higher receivable. So there is nothing, our costing takes care of this. So there's no cause of...
Actually, sir, my question was a bit different. I understand why it is high. But the question that I was trying to understand, that do we have any lever where somehow we can reduce it, let's say through, inventory or
this is, I understand, Divyansh, I understand what you're saying. So this year, the only one way which can happen is that we get a corresponding growth in domestic, because the blended working capital cycle will come down. But as long as my export business will increase, the export as compared to my peers in the export business and all, my working capital cycle is in line with the overall manufacturing process and the time it takes to reach there. One more thing we need to understand here, that most of my buyers are top AAA rated companies like BMW, Kubota, BRP, and also where hopefully there is no risk of any bad debt and all, and RSL never had a history of any bad debt and all. To answer your question on the livers part and all, yes, we understand that part, and we one thing which hopefully which we are focusing on this financial year is we are focusing on the domestic business as well. There are a couple of advanced discussions which are going on because the overall working capital cycle on the domestic side is much lower than exports. So that is one thing which we are working on. So hopefully we'll that should, and this Red Sea crisis is ending. So the whatever the 20-25 days of I think 15 to 20 days of additional working capital cycle which has come in, that will be taken care of.
Got it. Okay, I'll
Thank you.
join
Thanks.
back with you.
Thank you. Thanks. Next is
Ankush Agarwal.
Ankush Agarwal. Ankush is there. Ankush.
Audible?
Yes, Ankush, you're audible. Please go on.
Yeah, so my first question is, FY24, if I look at our growth, it's relatively lower than what our internal estimates were, around 470 crores of revenues. And considering other facts, that the kind of investment that we have been making in the business in the last 2-3 years, the kind of order wins we have got. So what are the challenges that we have faced? As a result, we have not reached the number that we have targeted internally. One of the reasons that on the grinding capacity you had highlighted, but anything else that you have that has impacted this performance, and how do you see execution going into FY24?
Ankush, it was a combination of problems, as you yourself indicated that once there was a short of grinding capacity was an issue. And of course, that was one of the contributing factor. And secondly, there was a slight, I will say, headwinds in European business, because European trends are showing a bit of slowdown. That also had a little impact, but it was a combination factor. But eventually, if we would have the grinding capacity with us, we would have recovered the entire thing. Because our business model is such that we are a diverse product company. So if one segment is down, other segment is up. One product model is not there, other product model is there. But it was a vicious cycle. That product model for which we had the capacities, there was a little headwinds on that. And the grinding capacity one was a major contributing factor due to which we could not do it. But now eventually everything is in place, and we are trying to now get back to the original forecasting numbers. Yeah.
So the 550 crores that we are guided for FY25, that stays on time, right?
Yeah, exactly. That's the reason. Yeah, you would have understood that eventually, if we have targeted from 423 to 550, so it's almost over 30% growth. So eventually, now we have the real capacities which we created last year. Although those capacities were delayed for almost 6 months, now everything has come into place. And eventually, if nothing untoward happens, so on this geopolitical things, so things will really work in the right direction now.
Okay. The second question was on the capex. So I think earlier we had guided that this year it would be around 60 crores. Any change to that number? And in line with that, another commentary that was said that since the capex would be lower this year, we look to reduce our long-term debt this year. So
yes,
on that line,
yes. That's still there. That is still there.
That is valid. Yeah.
That is valid.
Yeah. In fact, the good thing is that whatever investments we are going to make this year, they will be primarily for preparing for the subsequent years.
Right.
So to be very honest, for this year, by and by, we are covered. But future years, since we have explained many times, we have a very long gestation periods for our upcoming projects. So all these investments, like Prabh explained you, or Jitendra Jan explained you during the interaction, that we are preparing for that Project Titan. So that Project Titan is for the futuristic, this for electric vehicle project for a German OEM as a tier one. Now, start of mass production is somewhere in 2026, I think August or so. But plant readiness has to be in January 2025 because their pre-series cars or those field trial cars have to be from the mass production lines. So at least basic set of line, at least single equipment line has to be installed by us within this year. So we are preparing these investments physically for those future years. So I'll say in conclusion that for this year, by and by, we're already prepared for achieving what we are targeting.
Thanks, Ankush. Thank you. Thank you. Next is Anirudh Shetty. Next, Anirudh. Is there?
Yeah. Hi, I'm there. Am I audible?
Yeah. Anirudh? Hello? Yeah, Anirudh?
I'm there, but am I audible?
Yes, you're audible, Anirudh. Go on.
Yeah. I mean, I had a couple of questions, but I'll probably ask two and I'll just join back in the queue later. So my questions really are, we are very well established in two-wheeler and, we are now looking to, grow and make bigger strides in the four-wheeler segment. But in terms of the kind of parts and the kind of, products we're doing in the four-wheeler today, where would you slot that in terms of, criticality, in terms of margin, and just how do you see this journey of us, becoming, better in the four-wheeler space play out over time? Just wanted the evolution over there.
Yeah, to be very honest, these things are generally not for the public domain. No manufacturer will really divulge the real numbers that which segment is producing what, which product is producing what, because they are generally very price sensitive informations. And competition also these days is very, very sensitive. So we have to maintain this confidentiality because normally it will not be appropriate on our part to really divulge these numbers on a public forum, because they are actually our company's own GSP. I think probably you agree with me. What is your thought on this? Because price sensitive information, that which segment is producing what, or which profitability of two-wheeler or three-wheeler or four-wheeler for that matter.
I think that was not the question.
Yeah, it is his question.
No, his question was that in car business, what is the complexity of the operation?
No, he said the margins or the profit.
Anirudh,
What is your question?
Anirudh, can you repeat your question, please?
Yeah, it's more about, we're well established in the two-wheeler space, and, over time we've, gotten more complex products because we, the customer trusted us, and, we're trying to now replicate that journey in four-wheeler. So I just want to understand, where were we in that journey on four-wheeler, and, over how many years do you think you can actually get to the level that you are, seeing in the two-wheeler segment?
Complexity and how much time we can take to reach.
Yeah, one thing is that one thing is clear. Four-wheeler business has to be very, very complex business as compared to two-wheelers business. So it's very clear that two-wheeler is, say, graduation, and then commercial vehicles is, say, post-graduation. Then passenger car business is master's degree or the doctorate degree. So complexity is going to increase. But eventually, whatever learnings are there from one segment to another segment and to next segment. So eventually, this is how the life is working. Because if you really see 100 years back, they were all crank-driven cars where man has to start it manually by pushing the rope or by pulling the rope or cranking the engine. Today, we just push the switch and engine starts. Something similar in two-wheeler and four-wheelers and all. So eventually, business is more complex happening in passenger car business or commercial vehicle business. But here lies our expertise, because since we were there in two-wheeler, also in complex two-wheelers, not simple run-of-the-mill two-wheelers. They were all high power, high segment, 800cc, 1 liter, 1.5 liter, 1.2 liters. So they were per se very complex product as compared to typically which we see on Indian roads, 100cc or 150cc. So we already were at a certain level. Now we are into next levels of complexities. And that way we are technically fully competent, technologically we're fully competent, and we have all the team members to do that.
Anirudh, I'll add one more thing here. One of the challenges, which we face is, as I had explained in my first slide, we have more than 900 plus SKUs. Okay, and this is of course because and it is trust me, practically it is very difficult to handle so many SKUs on a monthly basis. So
Right.
one of the benefit in the passenger car vehicle segment is that the number of parts are not that much. They are more complex, but the number like a one assembly in two wheeler may have 30 parts, but the similar kind of an assembly for a passenger vehicle will have only 8 or 9 parts. So that is also one of the focus area we have now, that how can we control the number as the business grows. It becomes practically impossible to handle so many SKUs. So though they are more complex, but they give us a benefit that the number of SKUs hopefully will get normalized and decrease in the passenger once we'll grow further in commercial vehicles and the passenger car vehicles.
So is it fair to assume that like a passenger in commercial vehicle, as it grows as a share of mix, the return on capital employed could be better because the inventory days will be better over there, and our asset turns actually our asset turns will be better because we'll be able to kind of run the assembly line in a more streamlined manner, and since it's complex, the margins are just as good there. So then ROCE should just go up with time. Is that like possible?
Yeah, to be very frank with you, inventory days and all, I think I understand you always have this question on the asset turnover thing and all, and we always give the same answer. Asset turnover we have been focusing on, but it will take some time, because the good part is that quite a large number of investments and recouping of the plant is already done. But whenever a new business come in and all, then this is a peculiarity of our business, as MD sir had explained earlier. The gestation period of our business is much higher. Okay. Now and secondly, I always maintain that our value addition is almost 70%. Now if someone for a 30 rupees raw material component, if someone is paying 100 rupees, then of course it's because of the technology and the capital investment which we have. We can have a 75% raw material component and earn a EBITDA margin of 7-8% and all, or we can have a raw material component of 30%, do some capex and earn an EBITDA margin of 25%. Now that is a choice which we need to make. Having said that, yes, we are focusing on that part, but I think if you're saying that once the share of commercial vehicle or a passenger car vehicle will increase, then it should improve my capital asset turnover ratio and all. I mean, hopefully, the way we are planning, our quantum of capital investment should reduce going further. Not that much as compared to the repayments which we have. That should contribute to the improvement in asset. I will keep it like that, basically.
No, actually, you might have already witnessed that the past 2-3 years we had to invest very heavily, because one side we were growing at 30% rate. On other side, we had to upgrade our old plant and legacy plant, which was almost more than 30 years old. So that also added to additional capital investment. And if you are joining our calls earlier also, so we had to last to last year, we had to invest a lot of funds on the housing campus for our employees. So all this combination of things, capex was high. But this year, if you really see, on one side we are targeting to grow over 30%, and other side we are saying that this year capex will be lesser than the last year, and the overall borrowing over repayment will be high, and overall debt will reduce. And we have also said just now that whatever capex we are doing, this capex, even in this year, whatever we're doing, it's not for this year. It is for year 2026, even not for 2025. So it really shows now that ratio of capital investment will start showing improving. Investment will start investment to turnover of what you are saying. It will really start showing improvement, as I'll say. Therefore, this year is already going to be an indicator. You already have all the numbers with you.
Right. Absolutely. No. Thanks for taking my questions. I have a few more, but I'll join back in the queue.
Thank you. Thank you. Thanks, Anirudh. Next is Mr. Manjeet Buaria. Is Mr. Anirudh, Manjeet is there? We move to a question. We can take few questions from the people who are.
hand raise करके उनको पूछो.
Mr. Pratik Kothari. हेलो
अपन अनम्यूट कर दो.
हाँ मिस्टर प्रतीक कोठारी. नहीं अनम्यूट है. ओके मूव टू मिस्टर रुद्रेश. मिस्टर रुद्रेश. हेलो.
Hello, am I
Yeah.
audible?
Yeah. Who is that?
Yeah, Rudresh here.
Yeah. Hi, Rudresh. Hi. Go
Hi.
on.
See, I got a couple of questions. So, any thoughts on reducing debt by stopping dividend?
Stopping dividend.
Yeah. No, at least it will be
So,
get it with
you are an
reasonable.
investor. You should rather say thanks to management that we are paying dividend. Huh?
No,
But you know,
in the long run, it will help us out, right? So that's why.
no. We will say that there are all kinds of investors. There are few investors who are holding only 100 shares. There are few investors who are holding only 10 or 20 shares, and few are, of course, large investors. So small investors always look forward that there should be some dividend income should come, and for that matter, even large investors do also. And dividend is more of a kind of trust building and confidence building activity among the shareholders and investors, because we are almost 35 years old listed company, and we started paying dividend only 4 years back. So obviously after paying 3 years and we say we don't pay dividend, it doesn't look good. Well, first of all, if there is a happiness, this happiness should be shared to whatever extent we can share. Okay.
No,
So
it is
if
just like
this
taking out food
yeah,
from the financial institution and giving out to shareholders, right? So it should happen the otherwise.
yeah. No, actually, if what is the outflow out of the dividend? Only 1.5 crores.
1.5 crore.
So out of 1.5 crores, even we take a drop out of the bucket, the water level will not go down. If our overall debt is long term and short term put together around 200 crores, so why by removing that 1.5 doesn't make any effect. So rather it gives a little sentiment that okay, we are not sharing happiness with our stakeholders. So we say dividend is not a kind of payout. We say it is a kind of confidence and trust building with our investors. Yes, if company is earning money, whatever little bit we have surplus, we should always share happiness with our investors. And company will keep following this policy. And we wish a time comes when really profitability is higher and all other things are better. Rather, we should see if we can really increase the dividend. But to be very honest, we really want to respect this sentiment of taking care of small investors.
Okay.
It's
And
just
my
a token
second,
of appreciation, nothing else.
okay. Thank you. And my second question is, see, in the financial release, you people release the presentation, but it only covers the financial metrics. It doesn't cover rest of the moat or the showcase which we show in our investor call. So it would be better if we share the same presentation which we share on the investor call in the financial release as well.
We can try that, Rupesh. Actually, you understand, being a listed entity and all, we have to get our accounts audited, release everything. So, generally the practice which we are following is that a brief snapshot of but numbers whatever is related to numbers here, that we already release. I mean, only the business updates and all that we keep it for investor call. In fact, the number of slides, if you look at which were released earlier, were much higher. They were more detailed.
No, I was asking about the business updates only. So it would be better if we release it in the
That's not a
along with
financial, but that's not a
Okay.
financial. That is more for investor call, basically.
Okay, fine. Thank you.
Thank
That's
you.
it.
Thanks, Rupesh.
Okay.
I think Mr. Pratik Kothari is back. He just messaged that.
Yes.
Mr.
Hi, good
Pratik.
afternoon. Yes,
Yeah,
hi. I hope I'm audible this time.
Yes, yes, Pratik. Go on.
Yes. Hi, good afternoon, sir.
Good afternoon.
So my first question on the cost side, I mean, this year, be it our other expense, employee depreciation, interest, all seems to have gone up much higher than what we have delivered on the top line. So I believe this is all in anticipation of what we have to deliver this year, and all this additional cost that is hitting up P&L is related to that.
Yeah, Pratik. So, I mean, of course, the keeping the growth in mind and all, we have to hire people and all. One thing is, yes, you're correct that this disturbance because of the gear grinding capacity which had come in for few months and all, but all other expenses and all had been, as you understand, that employee hiring, and then there are a lot of tools and all which gets consumed as a part of our machinery and production process and all. So all those things were there, and there were few uh, like for passenger car vehicles, there were few tools which were deployed in the last quarter of the year, which of course will get used over a period of next 1 or 2 quarters and all. So yes, you're correct. The keeping the growth in mind and all, these expenses had slightly increased, but we have always maintained that as our business will grow, as the scale of operations will grow and all, our the EBITDA margin should be in the range of 20 to 22%, 23% and all. That is broadly, because as the scale of operations grows and all, every time the with each and every growth and all, keeping a EBITDA margin of 25% may not be possible. We have always maintained that. But yes, to answer your question, you're correct. A few bit of these expenses had grown.
But it was only 1%, one notch over 24% no, for the entire year.
EBITDA margin for the full year. For full year.
21%.
Yeah.
So, nothing can be always consistent.
Correct.
So 1% here or there, 2% here, there will always happen. Because always, all such margins are range bound. They cannot be handled quarter on quarter. They cannot be handled year on year. They have to be over a long period of time. So,
Correct. So my only question was that were there some additional investments in terms of other expense, employees, in depreciation, so in terms of capacity that we are doing in anticipation for the 550 crores that we intend to do, or is this a natural process and next year again we'll see costs going up? So this is the new. I mean, sometimes you invest in advance for future growth which might come in, and sometimes the cost structure itself has gone up. So I'm just trying to understand where are we in that.
I guess we already explained that this gear grinding capacity was a shortfall which we invested last year. And now, in fact, we have created a slight cushion also, because these gear grinding machines are lead time of a machine is 1 year. And we already burnt our fingers last year that we ordered the equipment, they got delayed, we couldn't get it. Now we have invested some buffer cushions also. Many times we get customers sudden orders for such critical equipment. So to answer your question is yes, we have created now some investment for cushion also. So this is 550. Idea is that for this year, at least we cannot say that we have any capacity constraints, because we already have created the desired capacity even as on today for this entire year. So if the projected forecast by the customers is being adhered and there are no any geopolitical things happening in a big way, minor adjustments here or there is always possible. So now technically this year we are having sufficient cushion for all the capacities. So this is how we invested very heavily last year, because since we suffered last year, so we then thought it is better to now play safe.
Right. No, fair enough. Fair. And sir, another reason I believe for slower growth this year was also the MAN project didn't pick up as was anticipated. So that is now back on track, and the numbers or the volume is what we were supposed to do.
All projects are moving in the right direction. They are on the anticipated volumes, anticipated forecasts. But like we are growing 20, 25, 30%. So obviously, no European company will grow 25 or 30%. So, but ours was always a new business, new projects, new models. But those customers they are having their own growth margins, growth targets of 5%, 6% on their each model. So those growth plans are there, but yes, trucks and all, there are now these days because of energy and all such stuff. There's a little weakening of the demands. I will not say a decline, but the weakening of the demand, or it's a little stock correction also, because in COVID time, everybody overproduced in Europe and US. Now they are taking care of the stock corrections also. These multiple effects are there, but we are safe because we are always having new launches, new products. So, we always are doing investments. Even now we are telling that to 2026 mass production, we are investing this year. So eventually, these kind of actions we took in previous years also. So eventually those models are now at the verge of starting. So business will really add up to these numbers. This is how, despite weak demands from across the segment customer profile, we are still anticipating growth because it's not only our existing model, new launches are also there. And when new launches happen, first 1 year is always stock, build up of stock, build up inventories. And, even in India, if any new product launch is there, everybody will produce very large number of vehicles. So this is how our business, it's a mix and match, but it really maintains our growth trends or our growth projections.
Correct. Fair enough. So my last question on the ZF relation that we have. We started the first plant, I believe, for one of their projects, and then over time we got 6 from them. And ZF also publicly keeps mentioning about this shift that they want to do from in-house manufacturing or from Europe to India. Just, sir, how is that progressing over the past year? In terms of what are we seeing, the conversations we are having, the RFQs, some qualitative aspect there.
No, that's progressing very good, because some of the project from ZF has already moved to our company, which was actually ZF was producing inside their own factory. So that has already moved to India, and we are getting very, very impressive RFQs for resourcing projects and also factory. That activity is really going on with a very strong note. But these big customers take their own cool time to take decisions. But yes, that ZF is really, in fact, probably if you can answer also how we are really progressing on ZF's future strategy, because ZF's in resourcing projects from India. So if you can update.
So basically ZF is going to be one of our biggest customer. The business only started a year and a half back. So that's on track. I think in the coming years, it should be sizable double-digit percentage. And this year also, they of course contributed majority. The projects which started somehow this year, there was some kind of impact on the sale from their customer end, but next year it is projected to grow. So far it is stable, and of course on the new projects we are in advanced discussion in many activities, but the current ones also have to peak up. So that is what now we are preparing for.
Correct. Sure. Fair, and thank you. And
Thank
all the
you.
best, sir.
Thanks. Fine. Next is
Yeah, I guess,
Saket. Next is Mr. Saket Kapoor.
Yeah, Namaskar, sir, and thank you for the opportunity. Sir, firstly, could you quantify the impact of this gear grinding unit in value terms? How much has it impacted the revenue, or how much has the bottom line being impacted?
we lost almost 40 crores of sale in last year because
Postponed.
It was postponed or delayed.
Postponed.
And eventually out of this, you can say around 20-30, almost 50%, 40% sale was on account of this gear grinding loss. Yeah.
So this gets booked in this year, and our number of 550 includes this 40-45 crore loss revenue.
Obviously.
Obviously.
Yeah, obviously.
Okay, sir. And for the Titan project, what have been our capex? अभी तक हमने कितना spend कर दिया है और ये कैसे phases में spend होगा ये रुपए कैसे लगेंगे?
यार देखो ऐसा है कि on such forums it will be difficult for us to quantify to such micro levels, but we have already told that total investment is for planned for this year is 60 crores, and out of this substantial portion is going to be invested for the Titan project. But specific investments details will be little not possible for us to divulge. But yes, within this 60 crores, substantial portion is for the Titan project. And in coming year, because we told you that startup production is 2026, so substantial will be done this year. Then eventually when the mass production starts, then we have to add some duplication of we have to then do the capacity building. Like if we need 5 machines and initial phase we add only 1 machine. So eventually remaining 4 machines will be required as and when the mass production starts. And it will also be, even when the customer starts, it will not start full volume from the first year itself. So it will happen in a phased manner. So eventually we will keep on investing, and it's not really possible for us to dig out details at such micro level.
Right, sir. But sir, you can give the entire project cost. I'm not asking the breakup for every year, but total how much are we going to spend on this project by the time it is full?
Not possible. Those phases, it will be in
अच्छा,
phases and all.
It will be
ठीक है,
spread
sir.
over 2-3 years. Actually, it will spread
No
over
issue,
2-3
no
years.
issue, sir. Okay, sir. Jitendra
right
ji, can
now
you
it
give
is
me the yes, sir. Jitendra ji, can you give me the current maturities for this financial year? क्या repayment है हमारा इस बरस का?
Close to 48 crores.
Okay, and sir, when we look at the cash flow this year, the tax payment has been doubled than last year. So can you explain the reason why
Cash
our
payment?
tax,
What do you mean?
the payment of taxes, direct taxes which we have paid?
Actually, there was some payment of previous year, which 5 crores was a payment of last year, which has got paid this year, which was not paid
Prior
last year.
period item also. Okay.
Yes.
Okay. And lastly, sir, you mentioned 40
Sir,
crore.
please let's stick to 2 questions. There are other people waiting.
Okay. जी. धन्यवाद sir आपका.
Thank you. Next is Mr. Manav. Mr. Manav. Mr. Manav. Let's move to Miss Divya.
That's it.
That's it.
DJ Piyush. Piyush.
Mr. Piyush Jain.
I think this is the last for the day.
Yeah, this will be the last question. Mr. Piyush Jain.
Am I audible?
Yeah. Mr. Piyush.
Yeah, am I audible?
Yes, you are.
Yes. Please go ahead.
Yeah. Good evening, sir, and thank you for giving us opportunity. So just one thing to know, last quarter, our gross margin has reduced a little bit. So just want to know what is our number which we think this gross margin we will able to manage and work out in the coming year and quarters. Is it something pricing related issue where the pricing has been not able to pass on, or the cost has increased of the raw material component?
The gross margin has improved from 70.19% to 71.06%. It's not reduced.
Gross margin has improved rather.
Improved.
Okay, maybe my calculation was maybe.
Yeah, it has improved by. I mean, I would say by just a 1%.
Okay, so the margin has dropped. So you will be able to recoup again the margin level of 23, 24. What is the guidance? Because I joined late, so I don't know if you said something.
So EBITDA margin is also, so last FY 23, 22, 23, it was 24.69%, and FY 23, 24 is 24.09%. So I mean,
Yeah, I
this
know.
much of variation.
It's only 0.6%.
No. No, sir, not asking for a full year. Last quarter, let's say we have at some 20 point something. That's what I'm asking. We will again come back to 23, 24 only for full year basis future, or that is what the one
Yeah,
last quarter is
yeah,
now.
of course. Actually, last quarter we already explained, since major capitalization happened in last quarter, depreciation margin was really very high, due to which all these issues.
He is talking of EBITDA margin.
Yeah, yeah.
EBITDA margin, but there was some.
EBITDA margin, there's hardly any reduction.
Quarterly is not, and the PBT part which you're talking about, I mean, yeah, it was because of a little higher depreciation and finance cost. But anyways, what we are saying is quarter on quarter maintaining would not be the right way of looking at it. We have to look at it at full year basis.
No, I'm not looking at this. Yeah, sure. I said just one more thing. How much capex we have already done and how much is planned for next year?
There's already planned for 60 crores for this year. It's already disclosed here.
It's already disclosed.
Okay. Any new client we added during this quarter or something, or any LOI or something is going on other than Z?
Brother, we are a B2B company. We can't add customers on a quarterly basis. We have to add customers maybe 1 year or 2 years.
Sir, but earlier you used to give exact details of this quarter we have added like Kubota.
Yeah. So that's what I'm saying. Okay, we have to actually add customers, because if you really remember, I always say our strategy is that every 2-3 years we should add one new customer. Because we are a B2B company. If we add, I wish I can add customer every quarter. But then the entire automotive industry will come to India. So, but probably I will just clarify. Our business strategy is that year on year, we should begin to maintain 20-25% of growth. We should always target 5 to 10% of growth from the organic growth of our customers. And every 2-3 years, we should add 1 or 2 customers. On an average, say 1 customer per year, so that we get about 8-10% additional businesses, so that 20-25% kind of normal growth we can attain. So this is our business model, but we can't really add customers every quarter.
Sure. Thank you.
Thank you. I think with this we can take just one last question. I think Mr. Manav is back. Mr. Manav, can you please go on with your question? Mr. Manav? Mr. Manav, you have to unmute yourself. I think it's not there. So we can end the.
Yeah, he has written something.
So he has written the survey. We are growing. Sir, maybe you can answer here. So he has written that, sir, the way we are growing, are we finding any difficulty to get skilled manpower and managing and retaining them? And also, how do we plan to upskilling them?
This is a very hot topic we have touched. Yes, getting on one side, we always say India has a huge manpower pool. Our average age is even, I think, 30 years or so. But yes, availability of skilled manpower is a challenge, and it's not for RACL. It is for the entire high technology industry. But we are actually fully geared up to mitigate this challenge, because our HR department is continuously upgrading our capabilities to create skill set among the raw people. Because our company strategy is always to get employees from the colleges, whether they are plain graduates or BScs or BAs or ITIs or diploma holders or graduate engineers. So we develop a complete skill set of people, and our HR department is really working very strongly to create virtual skill set centers and all such activities. So, but yes, this is a challenge which we have to fight at. But only thing is we have to create our capability, because we cannot expect our engineering colleges or the ITIs to upgrade immediately. But we are focusing on this field and we are quite successful. There are no major concerns to operate our company to the level we want.
And I think this was the reason we had invested in the housing complex and all,
Yeah.
because we provide that kind of facility.
Retaining those people.
Retaining the good talent. And all,
Yeah.
that was one of the reasons we had done.
And we have invested a lot. Yeah, JJ, you said rightly, this is the right way.
Yeah, that's
We are taking care of people because training them is an art, but retaining them is a science.
Yes.
So we have to really put in a lot of new ideas and innovations to retain the people. So that's the reason we are really taking a lot of initiatives to retain the people. I think with this,
yeah,
should close.
we can close.
Yeah.
Any closing remarks from your side?
No, I'll say to all my friends, colleagues, investors, stakeholders, keep your question and answer section very, very productive. It really keeps us on toes to really prepare ourselves and to continuously perform ourselves, because we really appreciate this kind of quarterly interactions. And I will really put on record that yes, the kind of questions our colleagues are asking, they are really, it really reflects that you study our balance sheets very, very deeply and very, very strongly. So once again, my thanks to you all, and JJ, please keep preparing such presentations, and
Sure.
Thanks for your inputs onto this. And we really look forward to keep waiting. Wish you happy summer weather, and maybe people from Maharashtra, you must have started enjoying the monsoons. So please send some monsoons to Delhi also. We are sizzling at 48 degrees. So we eagerly wait for the good monsoons from Maharashtra to be released. Thank you, gentlemen. Thank you, colleagues.
Thank you. Thanks, everyone. Thank you.